Hello everyone, Michael here from Adventurous Real Estate Investors. Today I want to chat with you about our investment thesis so you can understand exactly what type of deals we seek to acquire. In addition to building a strong partnership team, having a clear vision of the assets we want to pursue is very important to us at Adventurous Real Estate Investors. We are always monitoring the economic climate and fine-tuning our investment thesis to reduce our investment risk. Therefore, our investment thesis is a living document and is continually reviewed and updated to ensure that we appropriately reduce risk. Our investment thesis is comprised of three core areas: returns, markets, and property class. Let's dive into each area a little bit deeper. Returns. When initially underwriting a potential deal, there are three initial criteria that must be met in order for us to continue to pursue it. They are: 1, cash flowing from day one. We will never enter a deal that is negatively cash flowing. Number 2, 40 to 50% of the returns have to come from cash flow. This ensures that we are not banking on appreciation, and if we have to hold the property longer to time the market appropriately, we will have a solid cash flowing asset that will make our investors happy. Number 3, it has to be a stabilized asset. It must be at least 90% occupied for at least 90 days, which allows us to obtain long-term financing, which gives us the flexibility to hold the asset longer if needed, time the market, and exit the property when it makes the most sense for our investors. This protects our investors' capital, which is critical during the current economic uncertainty. Once a deal passes these specific criteria, we then ensure it meets the following minimum returns: 8% cash on cash, 14% IRR, 80% total return, and a 4 to 7 year hold period. Second criteria is markets. We only seek opportunities in economically stable markets and submarkets. Here are 5 data points we review when considering investing in a particular market. Number 1, positive population growth. Number 2, positive income growth. Number 3, positive house value growth. The data show that apartment values follow residential homes by about 2 years. Number 4, positive job growth. And the last one, number 5, lower crime rates. If a city still looks promising after reviewing these data points, we will then dive a little bit deeper and look at the following additional data points, such as current occupancy rates, annual occupancy increases, net absorption, units recently delivered or planned to be delivered, annual effective rent growth, and projected rent growth in the coming years. At this time, we are very bullish on specific submarkets in the Tulsa, Oklahoma MSA because not only do they meet our criteria, this city has a lower investor competition, which ultimately allows us to provide a higher yield return for our investors. The last part of our investment thesis is property class. We target undervalued multifamily properties in order to increase operating income and decrease expenses by taking advantage of value-add opportunities. We are currently targeting B and C class assets that are 1970s plus vintage. Here's why. They are generally recession resistant. If someone loses their home due to job loss, they are most likely going to move into a B or C class property, depending on what their living arrangements were previously. An A class property will be too expensive for them to live in, and a D class property will be too much of a drastic change for them. Additionally, if someone wants to take a pay cut from their job that lives in a B class apartment community, they will most likely move to a C class community. Also, B and C class properties trade at higher cap rates, which means higher cash flow for our investors. Value-add business models can be applied across B and C class assets. A-class properties typically have rents that are already at the top of the market, which makes it difficult to add value, increase rents, and therefore increase the return for our investors. D-class properties are too high risk for us, given the amount of repositioning that would need to take place, and they generally have higher crime rates and low to no cash flow during the first several years, which we tend to avoid. My final thoughts are that given the current economic climate, the stage is set for the appreciation of hard assets in the years to come. Here are 3 reasons why. 1, the current record low interest rates and the expectation of them to remain low in the near future. Number 2, the fact that over 20% of all dollars in existence were created over the past year. This is filmed currently in 2021. So 2020 is when all the dollars came to existence over the past year. And number 3, the Fed's statement that they will let inflation run above its long-term target. Commercial real estate is the United States' largest hard asset class. Therefore, we want to ensure that we continue to seek value-add opportunities that fit within our investment thesis to position our investors to take advantage of this opportunity as the tsunami of liquidity is pumped into the market. However, as the economic climate continues to shift, we will continue to monitor each market we invest in to fine-tune our thesis as necessary and report back to you, our investors, on a regular basis. If you found value in this video, please smash the like button down below and subscribe to our channel here. Until next time, explore more, adventure awaits. Woo!